Hey everyone, welcome to the Real Estate Reveille, your dose of real estate inspiration. I'm your host, Daniel Coletti, and I'm passionate about helping you unlock the secrets to financial freedom through real estate investing and entrepreneurship. Whether you're a seasoned investor or just starting on your journey, you'll find practical advice, market insights, and actionable tips to help you build a thriving real estate portfolio. Let's dive into the world of real estate and take your financial future to the next level. So let's jump in, man. Bring us through the steps. They're going to apply, they've got their house in order. They've measured these 4 factors and gotten pre-qualified. What's the first step into going to get a mortgage?
Yeah. So the very first step that I think you should any prospective borrower should be looking at is to find their lender. It does happen. These things don't. It's not hard and fast. You have to do it in this order, but this typically is the smoothest order. I mean, you could find a deal, especially if you're an investor. A lot of times you find the deal first, and you go try to find financing for it. But if you've got a lender that you're working with already, that does help the situation. If you're a residential or a primary residence buyer, it definitely makes sense to find a lender first, especially if you're someone who's new to mortgage or real estate in general, because what a lender can really do is help you with your buy box from a financial perspective. So they're not necessarily looking at like properties with you and looking at backsplashes. There's real estate agents and other people that do that stuff. But from a money perspective, a lender can help you. They can take all that information that we talked about before, your goals, your intent, what is the purpose of the purchase, how long do you think you'll live here, do all that kind of stuff, run through it all with you and help you identify from a money perspective, narrowing down your budget, what your buy box is, right? Because some people care about that big number, that final number. Some people care a lot more about the monthly payment and how they structure the loan and what products they're looking at for you, will depend on what you want with regards to those things. A borrower, you might not be required to put a lot of money down, but depending on the situation, it may make sense, especially if you don't have some other investment to put that money into. It may make more sense to put more money down. In other cases, it may make sense to put as little down as possible. So that lender is that first person, that LO is going to be able to do that. And I recommend shopping around. Like hey, if you want to come and talk to me about mortgage, I'm all about it. But even if you're coming to me, like you're not going to hurt my feelings if you come to me with some competing offers and different things that different lenders are saying. Because at the end of the day, a smart consumer, you should be, especially for a home real estate. This is probably for most people that home is the largest purchase they're ever going to make, or it's going to be one of. And so, I mean, a lot of people are very comfortable shopping around when they go buy a car or when they go buy, the latest piece of technology or whatever cool thing they want. You should be doing that for this too. So go to, talk to a few different lenders, see what they have to say, get a feel for them, their customer service, how responsive they are, and how knowledgeable they are, what they can bring to the table. And then find that person that you really want to work with and get that pre-approval. So you get them all your information, to meet those, those debts, those incomes, they pull your credit score, all that information, talk about your goals. And then you have that pre-approval, which is really nice because a lot of times when you go on to the next step, which is starting to find properties and making offers, it's not always a requirement, but sometimes having a pre-approval from a lender that says like, hey, they've pre-approved me to purchase this property or to purchase up to this amount. That may make a difference when it comes to them looking at your offer and taking it seriously. And that leads right into that next step. Oh, sorry, go ahead.
Yeah, quick question, because you could see it said differently in different places, right? Is there a difference between pre-approval and pre-qualified?
Yes, there is. Pre-approval is what you're looking for because that is saying that you are approved. Now it's going to be pending some things because a pre-approval letter you and the property have not gone fully through underwriting, which is a later step. That's just saying that, hey, at first glance, all the information you provided, the lender is comfortable giving this person this quantity of money, or depending on how you structure that letter, it may say this person is qualified to purchase this property. That's basically reassuring the seller that your offer is a real offer that is backed by a lender. So that's where that pre-approval letter is much more important than like a pre-qualification. The pre-approval is what you're looking for.
Yeah, and then just one question that comes to mind, I think most people will ask about is, you're gonna pull folks' credit when you're getting that pre-approval. Does that hurt people's credit?
So there are two types of credit inquiry. There's a soft pull and a hard pull. The big difference is the soft pull is going to be usually what they'll do is, well, let me start with the hard pull. A hard pull is a tri-merged credit pull from like the three main credit bureaus. So
Euros,
like
yeah.
Equifax, Experian, yep, and Trend. And like they're gonna pull from all of them, find all your debts and income, or not your income, but all your debts and all that kind of stuff. Tri-merge the score to get you the average, and like that's your credit score. A hard inquiry does affect your credit score. So as a responsible lender, what I try to do is I try to make sure that the borrower, I don't, you're not pulling a hard credit inquiry without authorization from that borrower. And I have a very deliberate discussion with them to make sure they understand what that means. Now, it's going to give you a hit on that credit score. It could be like, 20 to 30 points, but it's temporary. It probably only lasts for a few months and then it'll come back. But if you have a bunch of hard inquiries in a row, like that might be a negative thing. So you want to be deliberate about that. What I and many lenders use to build that financial picture before you're ready for that hard pull is that soft pull. And that's really just pulling from one of those three. You get a good estimate of the credit score. It may not be exact. And you usually get the gist of the picture on the debts. So I have a very candid discussion with the borrower. Hey, what debts do you have that you know of? What loans, what big stuff? And I make note of that. And then I do that soft pull, which doesn't negatively affect them. And then that kind of fills in the picture. But there are instances where a hard pull will include something that the soft pull didn't, and that could change the credit picture. So there are a lot of lenders who will not give a pre-approval prior to a hard pull. It's very situational dependent, depends on the income type and the picture and all that kind of stuff. So that's an individualized decision. But it's very important as a borrower to be very open and candid and honest with your lender below, because at the end of the day, they're not the one that makes the decision. It's the underwriters and the lender itself that make the decision on giving you that loan. And so you're not going to be able to hide stuff from them. Just put it that way. So just be upfront.
But you shouldn't
They'll do
try.
that soft pull. No, you should not.
All right, awesome. Well, you given us our pre-approval level letter, and we're ready to go out and start looking at houses. What do we do next?
Yeah. So the next is the search process, right? I always recommend getting an agent for this. It's not always required. I mean, it's not required by any means. An agent, especially someone who's very well, knows your market very well, had a very strong background in the negotiation process, the whole process for buying a house. But I think I always recommend that. It's not always innocent required, but it is easier when there's an agent involved on the lending side as well. But yeah, the next really two steps: you get that agent or you get that search going, you find the property you want, and then you make an offer. You make offers. This is a shopping process. This can be very fun or very stressful, or a combination of both. But the really big milestone here is when you find the property you want, you make an offer, it gets accepted, and you go under contract. That's the next big milestone. Going under contract with the seller on that property. Then what that lender is now going to do is going to give you a loan estimate, which is essentially kind of like a fee worksheet. We'll talk very in depth about what a loan estimate looks like in a later episode, and how to compare estimates between lenders, and how to identify good and bad deals and things like that. But you're going to get that LE from your loan officer, which is going to say, hey, here's all the fees associated with this loan. Here's what it's going to cost you. But keep in mind, it's an estimate. And then you'll get a final closing disclosure at the end of the process, which we'll talk about. So that's the next basically two big steps.
And I know there's one thing in there, just to point back to the credit pull. When you're doing your shopping around, this is the part where it's important to be in open communication with the LOs that you're working with, because you're going to want one to be transparent with them. This is what this bank is able to give me. Can you beat it? But also, you want them to pull your credit scores around the same time, because the way that credit bureaus actually evaluate that is when it's for the same purpose around the same time, you're not going to get multiple inquiries against it. They're going to group those inquiries, and so it doesn't hurt your
Correct.
credit scores badly. So you don't want to, you don't want to be shopping around, get a pull, and then 3 weeks later go get another one, because those are going to show as separate pulls. But within 72 hours, 96 hours, usually you're okay with that.
Yep.
And
And,
then
and one thing too is like you said, if you're working with multiple lenders, which is okay, you should be shopping, like I said. Um, I mean, some people, this is personal preference. Like, you're not going to hurt my feelings if you shop me because I'm going to try to give you the best possible deal I can. And if I can't, and that other lender is giving you a better deal, then I'll just tell you, hey, I wish you luck. It's going to be great. But it's good to know that because for that's one of the big reasons is I can time my credit pool so that way it's not like double tapping you. Like if I know someone else is already doing a hard pull on you, then I'm going to go ahead and do my hard pull now too. Then that way, as opposed to waiting. And so, yeah, that is a good point.
Yeah, and the reason you're shopping is you're trying to see if you can get a better rate, and that has nothing to do with the LO. That is the risk portfolio that the bank currently has and where their rates are set, right? So they may have an entirely different portfolio than a different lender that you go to, which may change, the basis points that you're able to get between that. And, a tenth of a percent on a mortgage could mean the difference between $100 or more on what you're paying. And so that's what you're looking for. And so don't attack your LOs. Nando's a nice guy.
Yeah,
Um,
thanks. Yeah,
all right.
most rates are in a fairly narrow band. You're typically not going to see big swings in rates from one lender to the next, but you can see some variance and some difference based on the way that lender is structured. Like it's one of the things, like I mentioned, was that we're very lean, which there's not going to be a lot of fee. There's not going to be as many fees and things a lot of times when you work with us, but there are lots of other great brokers and lenders out there that can do really outstanding work and get phenomenal rates. And then there's also things that are like called buy downs where you can buy the rate down that may or may not be appropriate depending on the lender or the borrower's goals. It may not make sense to spend money to buy the rate down just based on how long it's going to take you to recoup that money. But once again, getting into the weeds on that we can do later, but the rates will probably not be that different. They'll probably be comparable for the most part.
Right. For sure. All right. So we've gotten pre-approved. We found our agent. We've got our purchase and sale agreement in, and our seller has accepted our offer. What are we doing next?
All right. So we've got that loan estimate. We are now moving into the due diligence phase. This is where we are looking for things like appraisals, inspections. As a borrower, you're going to shop for your insurance. So once again, I recommend shopping around, call a few different insurance companies, see what kind of deals they can give you. And you're going to need to give that information to the loan officer who will then package all that stuff up, probably with some help from a processor who does a lot of the back end admin side of things. And they will get that package. Oh, and also a lot of things like documents. So for example, if you disclosed, hey, I have these accounts with this quantity of money, they're going to need to see documentation, your bank statements, your ID, your W-2, sometimes your tax return, depending on the situation, things like that. So if the LO hasn't already collected a lot of that from you, they're going to finish collecting all that stuff up, make sure it's all current. And they're basically building the picture for the underwriter. They're packaging that. And then that next step, what they do is it goes into underwriting. They're going to hand that off to an underwriter with the lender. And, if it's a broker like us, that's going to be whatever lender we are working with in that instance. It will be with their lending team or their underwriting team. Some, like for example, a big bank, they do all things in-house. They've got loan officers. They do it all in-house. They've got in-house underwriters, and they hand that off to the underwriting staff. Either way, it goes to someone else, another person who will start assessing for the lender that risk. The loan officer's idea is to build the picture, be responsible and honest about that picture, and then hand that off to an underwriter who's going to complete the picture and make a decision. Will you receive this loan or not?
Yeah, and this is the part of the process that I know some people can get pretty frustrated with, and there can be a lot of back and forth going on between the underwriters and the person requesting the loan. Any tips for folks that are qualifying in terms of getting ready for the underwriting process and preparing documents?
Not so much for the borrowers. I think the biggest thing for the borrowers is just to be very upfront with the LO with regards to what you're trying to do. A good LO should be trying to make that file as simple as possible to make things go smoothly in underwriting. So they should have an idea. Hey, what is the underwriter looking for? What does the underwriter need? And giving those things to that underwriter upfront. So the biggest thing for borrowers is just be very, be quick to respond with your loan officer, disclose everything up front, give them, be responsive with regards to documents and things like that, because they may ask for bank statements. And if it takes you a week to get them bank statements or whatever it is, whatever that might be, that's another week going by where your loan isn't moving. So because when you go under contract, I should have mentioned this, they're going to set a closing date in that contract. The standard is roughly 30 days. I shouldn't say standard. The most likely is like a normal 30-day close for like a normal property. But there are quick closes, and then there's different types, lending that goes on. If you're going to create a finance or, seller finance or maybe a hard money, it might be like a really quick close. That's different. But for like a fairly normal residential mortgage, it's usually about 30 days. They can be longer though, depending on the scenario. You don't want to go past that, because when the lender locks your interest rate, which I should have mentioned, that's kind of up in that same area as the time they give you the loan estimate, they're going to lock that rate so they can lock it in for you. They might have to pay, if you have to extend your rate lock is going to be for a certain number of days. And if they have to extend that might cost you money. So you want to try to close on time. There are situations where it happens, you can't control it and you close late, but typically you want to try to close on time. That's important. And so being really responsive to the LO when they need things from you and bits of information. Now, a good LO should be packaging that stuff, trying to ask as many questions up front and gathering that all together. So hopefully they're not like nickel and diming you. But there are times where underwriters ask for things that the LO didn't account for. Sometimes you have to provide them like letters of explanation for certain things or whatever it may be. So throughout the underwriting process, the loan officer and that processor are going to be interfacing with the underwriting team and making sure that they have what they need. And then if they need something else, they're going to be going back to the borrower, like, hey, can you sign this? Hey, I need this piece of information from you. So just being responsive is important, because the next step, once you get through that underwriting process, well, typically it goes in steps or 2 steps here. You get kind of a conditional approval, which the underwriter will say, hey, you are approved for this loan pending these conditions. Hey, everything looks good. I just need hey, I need a new updated bank statement for this account because this one's out of date, or I need this, or I need you to sign this letter, or hey, I need the appraisal to be filed. So this kind of administrative stuff. But then once all of those conditions are met, then you get what's called clear to close. And that's the next major milestone, meaning you're underwritten. The lender is like, yep, you're good to go. You are getting this loan, unless, some crazy stuff happens, a hurricane hits and the property disappears. There's situations, weird stuff that can happen, but for the most part, clear to close is a very major milestone, meaning, hey, we're ready to go to the closing table. Yep.
You go to do your final walkthrough and the entire place flooded.
Yeah, that would be bad, because that is the next step. So we're up to step 7 now. So that's where you get the final balancing. So title documents, and this is where it goes to typically a title company or maybe a law office or something like that, where they're going to be doing the final, what they call balancing. So they're going to take everything that you did, they're going to look at that loan estimate and all the information, and they're going to start finalizing these numbers. It's called it's an estimate because certain numbers the loan officer doesn't have access to and can't control. Things like your taxes. A lot of times when they prepare the loan estimate, your insurance hasn't been set yet. So they're kind of giving you a good swag on those things. When you finally get that final CD or closing exposure or clear at the end, that is going to have all your finalized numbers. So depending on what month it is, the seller was responsible for taxes for that year up into a point. The borrower is going to be responsible for after that point. So they're balancing those numbers. Any seller credits that were added, any lender credits, all that stuff's getting put together, getting packaged. You get that final closing disclosure that says, here's exactly how much money you're going to have to bring to closing. Or sometimes you get money back depending on the situation. And so you get that final CD, you review it, you sign it to acknowledge, hey, I have all this information. And then you do that final walkthrough. Okay, is everything good with the house? Everything is as was. When we went through the initial walkthrough, I wanted these 5 things fixed. Did these things happen? Is it ready to go to close? And when all things are fine, the final walkthrough is complete. You've got your clear to close. You received your CD. Everything's balanced with the title. The last step, and the best part, is when you walk into that title office, sit down at the table, you sign all your documents, and you close.
When you get
And
those
that's
keys.
that's the final step. You get those keys. You get your cool picture with the big little eye closed house, thing. And then I guess the final step is you move in, get settled, and have a little celebration, the housewarming party.
That's it. There you go. Awesome, man. Through all that, one thing that did kind of telling on myself here a little bit when I was closing on that first property. My first property was the German house, which is its own thing. It was a German bank, totally different situation. So my first conventional mortgage through the VA loan for the condo here, I learned that I had some bad financial habits. And part of that was just like how cluttered my bank statements were. And especially once getting into the real estate game, I was like, all right, there's a better way to do this. And so I got into the habit of putting everything on a credit card so that my bank statements were actually very streamlined. The only thing that went out were my payments on that. And, you should pay that monthly for the most part. But it keeps, it shrinks your bank statement from, I don't know, 45 lines down to 4 or 5 lines, right?
Yeah.
And then that just makes life easier for the underwriter having to trace things down. And the other thing was moving big amounts of money on those statements. If you need to get funds into a certain place, if you're pulling it from a brokerage so that you have that cash reserve for closing or whatever, it's best to do that prior to those 2 monthly statements so that those funds are seasoned, just because you're not going to have to provide additional justification to the underwriters of where that funding is coming from.
And
And it cuts down on the back and forth between the underwriter, the LO, and the requested borrower. And those were some things that I did when I went to go buy that first property, and it added, a week or two to the process because just of the back and forth of having to answer what things were. And working through some of those documents. So just wanted to share that as an experience, some things that I learned going through that can kind of help streamline the underwriting process a little bit.
yeah, absolutely. That was one thing I probably should have mentioned earlier when you asked advice to borrowers. Be organized. Being very organized and keeping things as clean and simple as possible makes it, because keep in mind, like your bank statements make perfect sense to you, but an underwriter doesn't look at them they look at bank statements all day, but they don't know you. They don't. That's the thing, right? Your LO gets to know you throughout the process. The underwriter never speaks to you, knows nothing about you. Everything they know about you is from paper. It's from a credit report. It's from documents that you received to them. You've sent to them. So they don't know or care about you personally, not in a negative way, but the idea is just making it as simple as possible, being very organized in the way that you present your documents. If your bank statements are 30 pages worth of stuff, just keep in mind the underwriter is going to look at every single one of those pages line by line by
Mhm.
line. And if there's one very important piece of information on those pages, underwriters human, they're good at their jobs, but they might miss it, and eventually the LO can walk them in. Hey, I need you to go to page 7, line 6. Oh yeah, that answers the question. Cool. But it's more back and forth. It may cost more time and a little
Especially
bit
if you're trying
things.
to, do one of those quick closes, like a 3-week close or something like that. These
Hmm.
things can be very important, and you want
Absolutely.
to make sure that you're organized. Well, awesome, man. Great conversation. Again, walking through the different types of mortgages, some assumptions and misconceptions, the 4 basic, or 5, I should say, basic components to qualifying, and then there's your steps how to qualify for a mortgage. So again, Nana's going to be joining us once a month to talk about lending and mortgages and various topics there. So you'll definitely see him again. But for folks that want to reach out and get in touch, what's the best way to get a hold of you?
Yeah. So, well, first off, thanks for having me. I'm really excited about this segment, and you know, and what it's pretty awesome what you're doing with the podcast and everything else you got going on. So good on you, man. And this is fun. I'm excited to do more of these. But yeah, I'm on all the social medias for the most part. So I've got my Instagram. It is Nand. So for Fernando, Nand Tinez, Tinez, Nand Tinez. That is my Instagram. I'm on LinkedIn, Fernando Martinez, Fernando in parentheses, Nando Martinez. And then I'm on Facebook as well, Nando Martinez. So you can find me on any of those places. Feel free if you have questions, want to talk to the mortgage stuff, real estate investment stuff, run a few numbers. Let's do it. Just hit me up.
Awesome, man. And just like everybody else, I can't let you off the hook. Best book that you've read in the past year?
So there's a book I'm reading currently. I'm about probably 3/4 of the way, called The Millionaire Next Door. I guess I don't know. I'd say that's the one I'm focused on right now. So that's where my head is at. But that book is all about spending habits, budgeting, making responsible choices with your money. And, a lot of times it's called The Millionaire Next Door because you never quite know someone's financial situation by looking at them outwardly, their clothes, their jewelry, their cars. Like there are lots of people who have a lot of really nice stuff and they might earn a high income, but they don't save anything,
Yeah,
and
net
so.
worth is negative.
Yes, correct. So that I'd say that's a pretty good book, especially for building habits. I think one of my big focuses this year is habits and focusing on positive habits that I can apply towards just my personal life, my health and fitness, my real estate investment, and everything in between. And so that's a big one for me on the habit building.
Awesome. All right, man. Well, we will see you next time. Thanks everybody for joining us on the Real Estate Reveille Podcast.
All right. Catch you later.